The Bank of Canada started the new year the same way they ended last year, with a 0.25% increase to the overnight lending rate. Not great news, but there are some silver linings in today's report, so let's dive in. Today's decision doesn't really come to anyone's surprise. The decision was already locked in almost immediately after the December meeting. We had a couple of points of data come up that really solidified today's increase. One was an incredibly strong jobs report for the months of November and December. And then we had two inflation readings, one for the month of November, which showed actually a slight increase to inflation. And that really put the nail in the coffin, so to speak, on today's increase. Since then, however, and as noted in today's press release from the Bank of Canada, inflation is starting to show signs of slowing down, which is great news. The Bank of Canada also further noted that there are some economic headwinds heading in our direction. There is expected to be a slowdown in overall GDP. They aren't going as far as saying that we are expecting a recession, but they are acknowledging a slowdown. And they finish the press release with some new language stating that if things remain the way they are and continue to unfold the way that they expect, that this should be the last, the last increase to the prime rate for the current cycle. And they'll be holding it there, evaluating as all the new economic data comes to light. So where does that leave you if you are shopping for a mortgage or if you have a variable rate mortgage currently? Well, unfortunately, the prime rate is going to jump up at the bank. Currently, it's 6.45%, so 0.25% higher is going to bring it to a whopping 6.7. I think I have to eat my hat. I never thought that we would get to this level. But there are some positive signs, because fixed rate mortgages, which are trying to predict the future, they're a leading indicator, have already fallen pretty substantially from the peaks that we had October, November of last year. Currently, the lowest 5-year fixed rates are hovering around 4.5%. Now that's for high ratio insured mortgages, but we will see the rest of the market start trending that direction. And that means that if you are struggling under the weight of inflation, under the weight of increased mortgage payments on your variable rate mortgage, there will be an opportunity in the coming months to convert to a fixed and lower the payment. But that locking in comes at a cost, because once you lock into a fixed rate mortgage, you forego the opportunity to take advantage of lower interest rates in the future. And if things develop the way that is expected with a global recession and further drops to the interest rate, then at what level do you feel comfortable locking in? Do you take advantage now to lower your payment to survive, or do you hold on to the variable rate mortgage with the expectation that rates will be lower in the future? My name is Christopher Mulder. I am a Toronto-based mortgage broker. I do these videos for your benefit. If you get value out of this, drop me a line, let me know. Until next time, bye for now.